I think that gold has built a very big base around this level. It initially rose to around 2,000 in 2011 and then pulled back to 1,000 and then, gradually made its way back up again to 2,000, and it's kind of been hanging out around this area, and now it's been building a bit of a base just above 2,000. And I think we've been, compressing the support higher, and the resistance is there, but I don't think it's very formidable at around 2,100 or 2,150 or just above. A lot of people are still a little reluctant to buy gold above 2,000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest, but, there's not that much interest. And I think the upside potential is enormous relative to, the downside risk in gold from here. I think historically, if you look at, where gold is relative to, let's say, U.S. stocks, relative to the Dow Jones, with the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created in the near future. The inflation is all about money. We had a huge increase in the money supply, and that's the source of the inflation. That is the inflation. The impact that has on prices is a result, and we're focusing on prices, and we're not looking at inflation. And that kind of lets the government off the hook for creating it. And, it always annoys me when I watch some of the financial channels and they talk about, food inflation or rent inflation. There's no such thing as rent inflation or food inflation, as if landlords cause inflation or the farmers are causing inflation. They're not. Food prices are going up because the government has caused inflation. Rents are going up because the government has caused inflation. The inflation is the expansion of the money supply. And even though money supply has contracted a bit recently, compared to how much it went up, it's barely gone down. And so the prices still haven't adjusted to the money supply growth of the past. And inflation is not just about growth of money supply. It's about credit, because consumers use credit to buy stuff, just like they use real money. And so if credit is expanding and now consumers take that credit and they buy stuff, that bids up prices. Credit card debt is soaring to a record high. I mean, look at the last month. It was like 4 times estimates when credit blew up. Consumers are taking advantage of credit that is still plentiful and easy, and they're buying stuff. They're buying stuff that they can't afford, that their 2 or 3 paychecks still don't allow them to pay for. They find a way to borrow the money. And so as long as credit is continuing to expand, that's going to bid up prices, and prices are going higher and higher and higher. But when you look forward to this fiscal cliff and what's going to happen to money supply as the interest rates really start to move up, because nobody wants to buy treasuries. I mentioned earlier, somebody's buying treasuries, but eventually nobody's going to want to buy treasuries. And everybody who owns treasuries is going to want to sell treasuries. And that means the only buyer is going to be the Fed. But it's not just going to be treasuries. No one's going to want to buy any US dollar denominated debt, because none of the borrowers are going to be able to pay rates high enough to cover the loss of value of the dollar. So then the Fed might have to start buying municipal bonds, corporate bonds, everything, and it's just, just a spiral. And so it's not just that we've had so much inflation in the past, but that we've got so much inflation that's already baked in the cake for the future. That's why the price of gold really needs to start to rise to reflect that. Right now, people just don't get it. I mean, people are still optimistic. They're still confident in the Fed. They still don't understand, what's about to happen, because they don't understand what already happened. They still don't, know how the Fed created all these problems, how it inflated all these bubbles. They still think we have, genuine prosperity as opposed to a gigantic bubble. I think the reason that gold stocks have been as weak as they've been is really a function of, the outlook. Investors expect the price of gold to fall because they expect the Fed to be successful in its inflation fight. And as they, expect the price of gold to fall, they think that's going to reflect poorly on the future profits of these companies, and stocks, try to discount future earnings into the present. And if you have a bearish view on the price of gold, you're going to have a negative outlook on the value of mining companies that are going to be mining that cheap gold in the future. But also, it's, these gold stocks have been the ironic victims of inflation, because you would think, a lot of inflation, that's going to be good for gold stocks because, they have gold and it's an inflation hedge. But the inflation has pushed up the cost of mining gold a lot more than it's pushed up the price of gold. And so gold companies have seen their earnings suffer due to inflation. And that's because investors still don't appreciate the permanence of this inflation or how much worse it's going to get. And so they haven't, factored that in. So that's been difficult. But I think the gold price is going to ultimately catch up to where it needs to be. I mean, it's very, very underpriced right now. So I do think you're going to see a period of time where the price of gold will, rise a lot faster than the cost to mine it. And that will be great for these gold mining companies, not only for their earnings, their current earnings, but a lot of these gold companies have reserves that are assigned little to no value in the market because it costs more to mine them than the gold is worth. So let's say you have a part of your reserves where your mining costs is $2,300. You may have a lot of gold there, but it's $2,300 an ounce to get out of the ground. Well, it doesn't matter how much you have, it's not worth anything because you can only sell it for $2,000, right? So you can't make it up on volume, right? You've got a worthless asset. But if all of a sudden the price of gold is $5,000 and maybe the cost of mining that gold only goes to $3,000, now you've got $2,000 an ounce profit, multiplied by a lot of ounces. All of a sudden there's a huge asset there that was not there. So there's tremendous leverage, I think, in the gold mining stocks if we get the type of move that I expect in the price of gold. And I think if you want to get an idea of the magnitude, I think the last time we saw a move that I think is going to be similar to what's coming is in the 70s. Because in the 70s, the price of gold had been suppressed for a long time. And it went from $35 an ounce in the late 1960s to over $800 in the early 1980s. I mean, think about the magnitude of that rise, the percentage gain. And so think about where gold prices would be now or later if they did something similar. And what happened in the 70s, of course, is we left the gold standard. And the result was a big devaluation of the dollar as a result of us leaving the gold standard. Well, I think the next major move is going to be when the world leaves the dollar standard. And when that happens, when the dollar loses its role as the reserve currency, I think the next markdown in the value of the dollar relative to gold could be just as big, if not bigger, than what we had during the 1970s. So that is a huge potential increase as the world remonetizes gold, as central banks now move away from dollars as their primary monetary reserve, and they go back to gold as their primary monetary reserve. And that means they have to buy a lot of gold. And that also means everybody else is going to be buying a lot of gold, and there's not that much gold to go around. So the only way to make it work is with a much higher price. And I think that's what's coming. The dynamics do not favor the dollar as the reserve currency. Remember, when the dollar became the reserve currency, initially, number one, it was backed by gold. And it wasn't just backed by gold, it was redeemable in gold. But also, the U.S. was the world's largest creditor nation, and we were the world's largest net exporter. We had huge trade surpluses, and we were this gigantic creditor. So it made sense. Everybody needed dollars because everybody wanted to buy our stuff. We made all the cars. We made all the radios. We made all the appliances. I mean, all the manufactured goods were made in America. And so people needed dollars to buy all our stuff. But, flash forward to today, we're the world's biggest debtor. We have the world's biggest trade deficits. What do anybody need dollars for? No one needs to buy our stuff. We don't make the stuff. Right? So people have been recycling these surpluses into our debt, into our bonds. But we owe so much money that it's obvious that anyone holding our bonds is holding the bag. They're going to take losses. So it doesn't work. And we have these global imbalances, huge economic imbalances, because Americans live beyond their means. We spend, but we don't save, or borrow, we don't save. consume, but we don't produce. And this is a gigantic burden that we have imposed on the rest of the world that has to subsidize this. And the cost is getting higher and higher and higher. And so it's got to come to an end. And I think we accelerated the process early in the Biden administration with these sanctions on Russia, where we weaponized the exorbitant privilege that the world has given us against Russia. And we made an example, and we basically a warning, hey, if you own dollars, you better do what we tell you, or, we have the ability to punish you. And I don't think China is happy to be in that position. I don't think anybody wants to be in a position where the U.S. has that kind of power. So I think we've created another political incentive on top of the economic incentive to de-dollarize, to move away from the dollar. One of the things that happened early on in the 70s when we went off the gold standard, that's when we got Saudi Arabia to price oil in dollars. So, okay, well, you couldn't get gold for your dollars anymore, but at least you can get oil. We created the petrodollar. But, the world is moving away from that. I mean, more and more trade in oil now is occurring in other currencies. And so this process, I think, is going to accelerate in the years ahead, as this debt bubble explodes and we have to go back to QE, whatever we call it, in the face of escalating inflation. And then people realize that 2% inflation is a thing of the past if we ever actually had it, and it's going to be high inflation or double-digit inflation as far as the eye can see. And that means negative real rates on treasuries and U.S. debt, and nobody's going to want to hold it. And so then you're going to get this unraveling of the dollar. And then there's no way the dollar can be the reserve currency if it's losing that kind of purchasing power. So, there has to be a replacement for it. And the most likely alternative is gold. A lot of people, and it's very conceited, but people think that, well, the dollar will be the reserve currency forever because there's no alternative, because the euro is not a good alternative, the yen is not a good alternative, the RMB is not a good alternative. So there's just no choice. The dollar wins by default. Well, we don't need another reserve currency. We could just have gold as a reserve, because gold was the reserve before the dollar. It wasn't the British pound. I mean, the pound was the biggest currency in use, but the pound sterling was real metal. The world was always on a metallic monetary system. Gold, silver were money. The fact that we now have fiat, that we have paper as money, this is new. I mean, it started in 1971, so it doesn't have that long of a history. And I think its history is, replete with failures. I mean, look at all the problems we've had on this fiat standard. But I think that, experiment is coming to an end, and the world will just go back to what worked. And that is real money. I mean, you can have paper, circulate as a money substitute, but it has to be backed by something of real value. It just can't be something that governments create out of thin air.